Hey guys, how you doing? I'm Kent Tilley, and today I want to talk about something that Chad and I have been talking about for a little while, where we shared stories of our best fee-saving stories of the month. Um, Now, I haven't publicly announced how our new fee structure works because we had to work through a bunch of things, and a lot of times people ask the question like, I had talked to Adam from Parallel the other day, and he says, like, what's included in the $500 financial plan? Because, we charge more for our planning. And I said, well, in some cases, the $500 financial plan is just going to be us saying, okay, this is sort of the answers to the questions you have now. Now you can go on your way and just take that from here. There's not really any follow-up. And then sometimes I'll be like, in 2 years, you should come back and talk to us. We can work something out. Or, I think you're golden. In the case of somebody, maybe they've got all their money in group plans, or I think they're really good at investing on their own and they just needed a checkup. So it's mostly like a checkup. And in certain cases, I'll be like, you know what, you need help moving forward. And this is a case where these people needed help moving forward. So this is where, we're definitely not getting rich off of $500 plans, but at least we're not working for free anymore, because I basically used to do this for everybody that came to me. And that was no guarantee that I was going to be paid for my work. I just didn't want that anymore. It doesn't mean that we're making a ton of money off of this, but at least we're not working for free. I didn't like working for free. So that's part of it. So, okay, these people came to me and, they're a great couple, early 50s. They have 5 accounts totaling $750,000. 2 years ago, they had started with $900,000. The accounts have been down 17% in the last 2 years. I'm not saying that that's the advisor's fault, but all this advisor was doing was selling them on, their investment expertise. So when you're selling somebody and charging them this much for what you're doing, there should be an explanation as to why you're below average what everybody else has sort of done, especially since there's not a ton of risk in this portfolio. I'm not saying they're at fault. I'm not saying that this couldn't do better than any other investment strategy in the future. We never know that. Now, all of these accounts have the same structure, so I'm just going to run through one account, which was the Lira, which has $270,000 in it. And it has 4 funds in it. Now, these clients were under the impression that they were paying about 1% to their wealth advisor. Now, all this means is that what a wealth advisor is that they work for, in this case, the big green bank, and that wealth advisor has the ability to buy stocks, bonds, ETFs, mutual funds, etc., but does not give financial planning advice. So they are just giving the investment advice and having these accounts, and then their meetings consist of, I'm sorry that your accounts are down, it's the market's fault. There's no financial planning involved in this whatsoever. But in their case, they actually have pretty complex financial planning needs. They, want to start working towards retirement. The one spouse has gone from being an employee to a contractor or a consultant, started his own company. He's being paid really good money hourly, now being paid into the corporation. They want to move from a province that, has low-cost housing to a province that has high-cost housing in retirement. So they're going to need to figure out the best way to fund that, plus their lofty goals in retirement, plus all of the things they want to do for their daughter and grandchildren. So their short and long-term goals are actually quite complex. And so in this case, I say you actually need a financial planner, which in this case was me because this was my file. So now we get on to the LIRA. It contains 4 funds. So and I'm going to round up to the nearest $1,000. Fund 1 has $70,000 in it. It's the MMF 4629C, which is the Manulife Strategic Income Fund, which has an MER of 1.17%. Fund 2 has $18,000 in it. The Manulife Smart ETF, an MER of 0.28. Pretty good MER on that one. Fund 3 has $32,000 in it. The TD Global Tech Leader ETF, an MER of 0.71. So ETFs that have these higher fees like that are more specific. So this is a global tech leader, so there's a little bit more that goes into that rather than if you're just tracking, say, the S&P 500 or the TSX, which would cost a fraction of that because this is a more strategic fund. It's more, centric on one little sort of sector, right? And then the last fund, it has $150,000 in it, MMF 659C, which is the Manulife Dividend Income Fund, which has an MER of 0.89%. So now what we have to do is we have to times all of those values in the fund by the MER. So 70,000 times 1.17 plus 18,000 times 0.28 plus 32,000 times 0.71 plus 150,000 times 0.89. And you get a total MER, like dollar figure fee, of 2,431. So now you take 2,431 divided by $270,000 and you get a total MER of this portfolio of 0.9%. Not too bad, right? But that's where they trick you. This is where I've tried to talk about how right before I left Investors Group, all of the companies switched to what are called Series F funds, which means that they have a lower MER, but then there's an advisor fee on top of that. So now what we have to do is search for the advisor fee. We go further down into the statement, in this case, the monthly amount that was shown as the account fee, which is the advisor fee that goes to their branch, that goes to the advisor. Consider this part the same as what K4's fee would be. So their account fee for that month was $279. So you times that by 12. Now you have $3,348 per year. That is the account fee. Divide that by $270,000, and that equals 1.2%. So this advisor's fee on the $750,000 is 1.2%, and the MERs on the funds are 0.9%. Now this is easier math. 0.9 plus 1.2 is equal to 2.1%. So now remember, they used to have $900,000, now they have $750,000. So we'll use the $750,000 because that's what they have now. $750,000 times 2.1% is $15,750 per year for this advisor to manage this account and buy these 4 investments. The advisor alone is charging $750,000 times 1.2%. They, of course, do not make all of this money. But, I mean, in my best guesstimation on what they told me and how often they talked to him and the advice that they got from him, even giving him the benefit of the doubt, I would guess that he has not worked more than 5 hours a year on this file in his entire life. So what you're saying is somehow this advisor is worth $1,800 per hour to that management, and that's what they're charging him out at, and then they're paying him probably 50-60% of that. That is absolutely outrageous. Outrageous. I think it is insane that advisors make this much money. I have clients that, have a ton of money, and, we would charge them as percent. I would always keep dropping it because I'm like, I can't earn that much money off of you. I hate it. I didn't know what to do. I've been thinking about it so much. And this is where I came up with what I'm about to explain next. But already, they've paid me $500. I've put in 4 hours, maybe 5 hours worth of work into this file already. They have way more information that they've ever gotten before. This is a complicated file. Usually it doesn't actually take me 4 or 5 hours. I can usually do it, honestly, in about 2 hours or 2.5. I have an hour-and-a-half meeting and another hour and a half of sort of prep and writing up the report. So this is how our new fee structure works. We charge an advisory fee of 1% up to a maximum of $2,400 per year per couple, or if you're an individual, because it doesn't really make it that much more complicated, and I didn't want to get too into like, okay, individuals get this and couples get this. So that means that you're paying 1% up to $240,000 invested, but every extra dollar that you put in, every extra dollar worth of growth, our fee starts to go down, because I'm not working any harder or giving you different advice. So if they came to me with 900 or 750, it was the exact same job. And so that's where I found like the right cutoff in my mind was, okay, beyond that level, I just can't think about how, there are too many couples out there that, should be paying us more than that amount of money every single year. And I do not make $2,400 because there's overhead and other things. So this is not fully, this is K4's fee for existing and providing the financial planner. So you do that now. $2,400 divided by $750,000 is 0.32%. So that means an inheritance comes in, a new lira comes in, she wants to retire in 4 years and wants to consider doing a pension transfer or continuing with her pension. Now she knows that I'm not trying to actually sell her on moving the pension over if I think that it's a bad idea, because there's no longer a conflict of interest. And a meeting I had later today was with somebody that was considering a pension transfer. I ran the math. I said, absolutely not. If you move that money out of the pension, it's actually going to be like a loss of like over $1 million worth of value to you. This was the best pension I have ever seen by far. And she had run it by 2 different advisors, and those advisors were both like, you need to move it. We can do better than that, and you'll be left with tons of money at the end of the day. Which in reality, they actually would have run out of money in 11 years if they tried to draw it out at the same pace that the pension was paying it out at. So where they came up with that math is insane. So anyway, so 0.32. Now, for an example, if they had $900,000, then 2,400 divided by 900 is 0.27. So $1 million, 0.24, $2 million, 0.12. You get the gist of it. You see, because I found my job isn't any different. It actually becomes quite a bit easier when people have more money, because sometimes it's quite a bit more complicated for me to try and help somebody that has $150,000 or $200,000 to fund the retirement that they want, because I need to be quite a bit more strategic with it and help them not make mistakes, where these people actually have the ability to make the odd mistake and still be okay. So now I say, okay, we're charging $2,400. You're going to invest that money at Modern Advisor. In some cases, whatever, I don't care if you're like, I love to self-manage my investments. I'm really good at it. And I say, yes, it appears that you are. I like what you're doing. What we need is, our fee to be your planners. I am not your investment advisor. Modern Advisor is the investment advisor, the same way this guy at the big green bank was the investment advisor, where he was charging 1.2%. Modern Advisor is charging 0.4%. And then the funds that Modern Advisor are buying are charging on average, depending on the portfolio, about 0.2%. Sometimes less, sometimes a little bit more, depending on your risk tolerance. So in total, you have 0.2 for the funds, 0.4 for Modern Advisor, and 0.32 for K4 as your planner. So in total, the fee is now 0.92%. 0.92 times 750,000 is $6,900 per year. We now have a total savings of $8,850 per year. Plus, they intend on adding over $100,000 to their investment accounts every year for the next 5 years. Plus, there should be some growth. This means that their fee is going to go down. I'm not going to earn more money because the market goes up or down or less, or they add more money. I'm going to help them strategically plan their retirement and get there and achieve the things that they want to achieve. So before, they were paying for two things. They were paying for the funds, which was 0.9%. At Modern, you're paying 0.2% for the funds. Now, they were paying 1.2% for an investment manager. Now they're paying 0.4% for an investment manager that is actually a team of CFAs rather than one guy that has one designation that is a week-long course that is the Canadian Securities course. That's it. And a CFA is like the person that goes through the hardest school that I've ever heard of to be able to be a fund manager. So now you're paying a third of what you're paying for the investment manager, and they actually have really good credentials. Plus, you've got a website that allows you to do all of these things. And now you're paying 0.32 for a financial planner and a team of administrators that are going to help you move money, set up the accounts, do all of these other things. So before you were paying for two things, and now you're paying for three things that everybody needs. I think the thing that people don't need the least in a lot of cases is the investment manager, because you could go to a place like Questrade and buy a Questrade portfolio, follow the Canadian couch potato and build your own portfolio for really inexpensive and good funds and good investment strategies, things like that. So we are the financial planners and we charge that amount for that. So there's three things compared to two, and they're paying almost $9,000 less per year. You do that times 10 years, plus growth, plus extra savings. Now they're saving well in excess of $100,000 before they retire in fees. Not saying that we're going to guarantee better results, because they'll never do that. I don't compare returns. I don't give a crap about that, because we cannot control that. I do not know that. However, I know that I can help them with their planning needs, and that is a fair trade-off for value, rather than paying somebody $9,000 to buy 4 funds and kind of look at them every once in a while. Now, and in closing, truth be told, in this situation, they are going to be better off than even this, because now he's opening a corporate account where they're going to be saving the majority of their money for the next 5 to 10 years, and we are going to open a corporate account. So what I can do in this case, in a simple corporation, in a situation like this, I could say, okay, well, the corporation is going to pay the $2,400 a year to K4, and your personal accounts are going to have 0 fees to K4. So all $2,400 is going to be paid out of the corporation, which is completely tax deductible as an advisory fee inside of the corporation, so they can write off our $2,400 against any investment income they have inside of the corporation. So it's actually better than that. Now, I should say at the end, in the case of complex corporations with a number of assets, a whole bunch of things like potentially like trusts, properties, all of these other things, we do charge more for clients that have complex corporations. But if you're just like a consultant that's basically self-employed without employees, that just has a corporation that is basically just another account, in my opinion, we can work through that for that same fee structure. So that's how the new fee structure works. This is how these people can save, $9,000 a year, get a planner that's on their side, get a planner that's going to tell them the truth. And the one that I was going to do before this was another very significant savings model, and she's been on the fence for 3 to 4 months, even though I was like, you're gonna save $7,000 a year in fees when you move this from, but she's like, I am scared, Kent, because I like the idea of this big giant institution being behind my money. I say, I completely understand. It is scary to make that change, to make that leap. So in answering that question for anybody that's scared of that idea of being like, well, okay, there's a big bank or there's Modern Advisor, the big bank's super strong, and who is Modern Advisor? Okay, very fair. Modern Advisor is basically identical to that advisor at the big bank. So all they are is a wealth manager that has a company that manages, thousands of clients' accounts. Okay, so behind Modern Advisor is CI Investments. So that is the custodian of their accounts. Now, on top of that, Modern Advisor initially was backed by a company called Guardian Capital, which was since acquired by Desjardins Insurance. So Desjardins owns Guardian, which owns a big portion of Modern Advisor, which then has the back-end custodian support of CI Investment Management. So there's always big money involved in these things. And then the funds that Modern Advisor buys are BlackRock and iShares and Vanguard and BMO funds. We've all heard of those. They're very strong. If they fail, we are totally screwed. If Modern Advisor fails, well, they have a giant block of business that will be purchased. So this is same. If this guy dies, his block of business will be bought by another wealth manager. If Modern Advisor goes out of business for some reason, well, they still have all of those assets under their control, which are going to be bought by somebody. And your investments are still safe in those funds. So I hope that answers the question about whether or not you're fearful. I totally get it. It's a big thing. That sort of explains how, the $500 plan can work differently for different people, because sometimes at the end of it, I'm like, you're good to go. Contact us in 3 years unless something crazy happens. Or, you're totally good to go. I love it. You don't need anything ever again. You're amazing. You just wanted to check out. And other people, in this case, I said, you need a financial planner. If you want it to be me, this is how it's going to work. That's the bottom line. If they don't want to, that's totally up to them as well, and that's okay. It's just another option. I'm trying to let people understand that we aren't paid a commission. We are paid to do a job, and that's what we're paid. Hope that makes sense. If you want to learn more, please check out the website. If you want a $500 financial plan, you can check out the website, reach out to us. Thank you very much for watching. Hope everybody's doing well, and we'll chat with you soon.